Although when building out a portfolio, I like to build around ETFs and index funds, but the past few years, this has been a stock picker's market. Technology has been the leading sector in the S&P 500, but not all technology stocks are performing well. Communication services has been the second best performing sector, but Alphabet and Meta platforms have largely led that entire sector forward. In these types of markets, and in general, I always like to focus on quality. High-quality companies perform great during stock market booms. High-quality companies provide safety in recessions. As such, in today's video, I'm going to give you just a little bit of a sneak peek inside of my portfolio, taking a look at 2 stocks that I've been adding to recently, and even 1 stock I sold out of completely. But before we look at those, do me a huge favor, click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a little sneak peek into what I've been buying and selling. 2 stocks I've been buying, 1 stock I sold out of completely. Let's begin with what I've been buying. And this first stock shouldn't surprise you at all if you've been watching any of my recent videos or staying up with my live shows. And that first stock is Amazon, stock ticker AMZN. Now, I've held shares of Amazon for a number of years now, but of late I've been pounding the table, and I've been backing that up by making purchases of my own, back when the shares were closer to the mid 170s. Well, over the past month or so, shares went up as high as $202 per share. But amidst the tech sell-off we've seen recently, shares are now back closer to $180 per share. Right now, Amazon shares trade at a market cap of $1.9 trillion. And over the past 12 months, shares are up a staggering 35%. So even after this 30+% move in the stock over the past 12 months, I'm still looking to add to my share count. I'm looking to make Amazon one of the largest individual stocks in my portfolio. So what has me so excited when it comes to shares of Amazon? Well, if you look at a stock chart over the past 3 years, Amazon shares have gone nowhere. That would make you think that, well, is there something fundamentally wrong with the business? Are they making any improvements over that time period? And the answer is yes. In fact, the company has produced 70% more in operating income. Free cash flow has gone from negative and fell to negative $25 billion in the past 3 years to now having the company generating close to $50 billion in free cash flow. This company is producing more revenues, more operating income, and more free cash flow. And it's only going to continue to grow. So essentially, looking back over the past 3 years, you're getting another opportunity to buy shares of Amazon. Except since they're producing such better results, they're going to be even cheaper today. So let's take a look at that valuation. And let's begin by taking a look at 2021 first. So looking back 3 years, here's some of those valuation metrics. Shares traded at the end of 2021 with a PE of 65 times. They traded at a price to free cash flow of 25.4 times and an EV to EBITDA of 26.8 times. So now let's compare those to today's valuation metrics, the same exact ones. Well, you can pick up shares today at a PE multiple of 39.2 times, a price to free cash flow of just 18.2 times, and an EV to EBITDA of 20.5 times. As you can see, valuation is much, much cheaper. And in fact, all of today's valuation metrics of those that we just looked at are all below the company's 5-year average as well. In terms of analysts, over 40 analysts are covering the stock, rating the stock a strong buy with an average 12-month price target of $223 per share, implying more than 20% upside from current levels. Do not be surprised when you see shares of Amazon as my largest individual position within my portfolio. Now let's move on to the second stock I've been buying more recently, and that is Pfizer, stock ticker PFE. Now, Pfizer is performing much differently than shares of Amazon. Pfizer investors have been through a roller coaster over the past few years. During the pandemic, Pfizer was at front of the line, and shares were as high as over $60 per share. Now, lo and behold, we're looking back at Pfizer with a share price under $30 per share. After all, the company was front and center during the pandemic, gaining huge amounts of revenues, but those pandemic-related revenues are all but gone. Now we're returning to the Pfizer of old, which may not necessarily be a bad thing. The company has a loaded pipeline, and they're just not getting any credit for it just yet. The company currently has a market cap of $170 billion, and over the past 12 months, shares are down 25%. As I mentioned, very different than that last stock we just looked at. In addition to those pandemic-related sales being gone, the company is also coming up on the brink of many patent protections being wiped away as well, leading to a loss of nearly $15 billion in revenues once those patents are gone and generic drugs can come into play. However, on the flip side, the company received 7 new FDA approvals just last year. That's more than double any other pharmaceutical company that's out there. The company has this loaded pipeline, and they're already showing growth even when you exclude pandemic-related sales. Looking at this fast graphs chart, you can see that analysts are expecting the company to generate EPS of $2.72 per share next year, which equates to a forward PE multiple of just 11 times, well below the company's historical average of 13.5 times. And with 16% growth expected in 2025, that also gives the company a PEG ratio of just 0.7 times, showing great value for investors. Analysts also are seeing that value as they rate the stock a moderate buy, with an average 12-month price target of $34 per share, implying 16% upside from current levels. In addition to that stock price upside, investors also receive a dividend that is quite juicy and yields 5.6%, and a dividend that has been growing for 13 consecutive years and counting. This is a stock that's not only cheap, but also looking for a turnaround, and while you wait for that turnaround, you get paid a juicy high dividend. Now let's change gears and take a look at that one stock I have sold out of completely, and it's probably going to surprise you. And that stock is Iron Mountain, stock ticker IRM. Now, for those of you unaware, Iron Mountain is a REIT, and if you've seen any of my past videos, I'm a big believer in REITs. It's a sector to look for value. However, although REITs have been the worst performing sector over the past few years, not all REITs have been performing that bad, and Iron Mountain has been performing admirably. The company currently has a market cap of $29 billion, easily making it the smallest company on our list today. But over the past 12 months, shares are up nearly 60%. Look here at this chart and look at the names that shares of IRM have outperformed over the past 12 months. The likes of Apple, Amazon, Alphabet, Microsoft, and Tesla. Those are some massive companies that have seen big increases in the past year. Okay, so you're probably saying to yourself, well, that just might be that particular time period. What happens if you zoomed out a little bit? Well, let me show you over the past 3 years. Looking at this chart, you can see that IRM shares have more than doubled up all of those same exact names, gaining nearly 125% over the past 3 years alone. Again, this is a stock that I've held for a number of years, and the gains that I locked in were slightly over 200%. This stock did way more than I expected. And although I believe that the REIT sector has a lot of value upside, I believe right now there's a ton of high quality REITs out there that are trading at discounted prices. Right now, in terms of valuations for IRM, I just don't believe that's the case. I believe it's actually quite opposite, an extremely high valuation. Perfection is priced in. Analysts are looking for the REIT to generate a FFO of $4.80 per share next year, which equates to a forward price to AFFO multiple of 20.4 times. For comparative purposes, the REIT has traded with a 5-year average of 13 times. Iron Mountain and their management team have done a fantastic job over the past few years. A lot of us know Iron Mountain for their shredding and paper storage, but they've been building out over 5 years now their data center foothold, becoming one of the larger data center exposure REITs on the market today. But they're trading like they are a 100% focused data center company, and that's simply not the case. There's a huge disconnect between results, which have been fantastic, and valuations. Again, the investment did way more than I expected over the time period, but I'm going to take my 200 plus gains and put those in a few high quality REITs that I believe have great upside. So there we just looked at 3 stocks, 2 that I've been adding to, and 1 REIT that I sold out of completely. Down in the comments section below, let me know what you think of these moves that I've made, and let me know some moves that you have made more recently. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.